Hi guys, Gusty Wins here, and welcome to episode 1 of my Learn to Invest series. In this series, I'm going to lay out the foundations for how to get started in investing, and this will be helpful if you're a total beginner and have a bit of money that you want to invest, or if you're already trading and want to learn a bit more. As a quick side note, because I get asked this all the time, the reason I'm doing this is twofold. Firstly, there is a bunch of misinformation on the internet, and I feel there's a desperate need of a credible industry resource. And secondly, I'm a strong believer in democratization of investing. Trading shouldn't just be for Wall Street, it should be attainable for all. So without further ado, let's get started. Very quickly, let's go over what a stock is and why they go up and down. A stock, or a share, it's the same thing, is a part ownership in a company. When you buy stock, you aren't buying a lottery ticket. It's not just a number on a screen which goes up and down at random. You're becoming an owner in that business. If you understand the underlying business and its drivers, you'll have a much better idea at guessing where the stock price is going to go. So, stocks sound complicated, but everyone knows what a business is, right? And why does a business exist? To generate profits, or as the street refers to them, earnings. On a very simple level, when you buy a business, you'll pay more for a company with higher earnings and less for one with lower earnings. So, when expectations for earnings go up, usually the stock should follow, and vice versa. So, Gusty, what you're saying is that I should just buy companies who are growing earnings forever and I'll always make money. It's not quite as easy as that. Growth in earnings is just one cog in what I refer to as the holy trinity of investing, something they don't teach you at school. The other two components are risk and valuation. Risk. What do I mean by risk? Well, markets are dynamic, economies are inherently volatile, and new entrants are constantly coming into the market to try and take what you have. The first rule in business is there's no such thing as a free lunch. If you're making money, someone else is trying to take those profits off you at all times, no exceptions. Hence, there's no guarantee that a company will ever be able to grow earnings for a long amount of time, or grow earnings at all for that matter. Take Kodak as an example. Once the leader in cameras and a stock market darling with explosive earnings growth, now is a formal shell of itself as digital cameras have totally cannibalized its business. Blockbuster is another example, once fast growing and now bankrupt. Those are two structural examples, but the economy can also cause earnings to shrink. Just say you're in the airline business prior to COVID. Well, we know what's happened to airline earnings, and yes, the stocks fell a lot too. Generally, the economy isn't static. It goes through cycles of expansionary and recessionary times. Cycles are very important to understand, so I'll cover them properly in another video, but it's something that you need to be aware of, and that could affect the value of your stock. Okay, so now you say to me, Gusty, I know the perfect stock. It's called Facebook. It grows every year, and the risk of people stopping using Facebook and Instagram for competitors is pretty low. That stuff is addictive as hell. Great. Now you have to consider valuation. Valuation is a simple concept, but it usually takes people a while to fully grasp. Valuation refers to the value of the underlying business. One of the most important concepts that you need to get through your head early on is the difference between price and value. Price is what you pay, value is what you get. Let's use the example of one of my businesses, Gusty's Lemonade Stand. My lemonade stand generates $100 per year and will generate $100 per year for 10 years. What are you going to pay for that? Well, let's start with the sum of payments that we're going to get. 100 every year over 10 years. That's $1,000. So is that the right value? Let's think through that intuitively. You're giving away $1,000 today to get given $1,000 back over the next 10 years. Why would anybody do that? There's no return in it. I can leave my money nice and safely in the bank and get $2,000 per year. It's not much, but it's more than that, and I don't have to take the risk of waiting for the earnings to come through from the lemonade stand. So now you say, okay, I'll pay $500 for the business. That means you're making $500 in excess profits over 10 years, so on average about $50 a year on an investment of $500. Is that a sensible investment? Well, now you're making a 10% return. Some of you might say that sounds pretty cheap. Some of you might say that's expensive. And that's what the stock market is doing all day, every day. One person is buying the stock, another is selling it, and it's finding a price where the collective wisdom of the market participants agrees on what a company is worth. Now, To make things even more confusing, just before we wrap up, let's add growth and risk into this equation of the Holy Trinity. The company might grow its earnings if it can win share of Johnny's lemonade stand down the street, but if the economy is soft, demand for lemonade might go down. Oh, and if the weather is bad, lemon prices might go up, squeezing the company's margins. Lots and lots of variables, some we can estimate, some that can't possibly be known. So where will earnings go? Your job as a stock analyst is to balance the Holy Trinity and come up with your own value for the company based on the research that you've completed and based on the likely outcome of earnings due to future events. For example, maybe you've tried Johnny's Lemonade and you think that it sucks, and over the next few years, Gusty is going to take market share because its lemonade is much tastier. If your value is higher than the stock price, then you should buy it, and as those events play out, i.e. Gusty's lemonade stand grows its earnings when it crushes Johnny's stand, then the stock should increase and you'll make money. In our Facebook example, we need to do this valuation analysis and compare it to the stock price to know if it's a good buy or not. So that is the basic concept or framework that I use for analyzing stocks. I apologize if it was a bit complicated, and I'm going to break this down into smaller and more practical increments, which I plan to release once every week, so that you guys can actually see the steps along the way with examples and start to build up your own framework to how to think about investing. Please like the video and subscribe to the channel if you found this useful, and make sure that you don't miss the next episode. Thanks very much for listening.